Well, Hulamin came out with their interim results earlier today. Headline earnings per share doubled to 22 cents. And here to unpack these numbers and more is company CEO Richard Jacob. Thanks so much, Richard, for joining us today. Well, so an impressive set of numbers coming through today in line with expectations. As I said, earnings per share doubling to 22 cents while revenue climbed 18%. Traders at the desk this morning highlighting, though, that we've got to take into consideration that this is coming off a low base. And then you've got an insurance settlement of 26 million rand, that's really pushed up headline earnings by 167%. So run us through this first half as it's been for you.
Thanks, Alishia. Yes, on the back of some improved volumes, improved margins, improved mix, the business is operating well, and we had a reasonably solid first 6 months. Unfortunately, the business is sensitive to the rand through our exports, and that offset a lot of those operational benefits. So that's really the story of the first half.
Let's run through the operational benefits first at the top, because having said all that I did in the beginning, still to bear in mind is that you're a company operating in a very difficult market environment where manufacturers have increasingly come under pressure because of rising input costs.
Yes, Hulamin is significantly exposed to exports. The local market hasn't grown at all, so all of our volume growth is really being taken up in our exports. Those markets are reasonably solid, and certainly the first quarter was quite solid. The second half has come off a bit, but the increased volume does result in a lower unit cost. At the same time, we have seen US dollar margins increasing somewhat off a relatively high base last year. At the same time, looking forward, there are some concerns in the US and European markets, as I said in the commentary, where I think in both markets there's different reasons, but the markets are a little unsettled at the moment. Fortunately, we have a full order book for quarter 3, and we're looking okay for quarter 4.
In terms of measures you're employing to improve efficiencies, because for now improving productivity means for the most part employing fewer people, and that's how the equation has been balanced out for the most part of that industry. How is that how is that scenario looking for you? Are you looking at reducing costs that way?
Look, we have had a reduction in numbers over the past 12 months, been done through not renewing temporary contracts. Also, we've had a natural attrition of about 110 employees, and we unfortunately remain above international benchmarks for our employment numbers, but we're not planning a major intervention in terms of a retrenchment or anything like that. We certainly are looking at a number of other ways of reducing our costs and improving our performance, not least of which is real cutting of costs in terms of procurement, in terms of efficiencies. So there's a number of other ways we can keep costs under control.
Of course, that critically important where, like you say, you've got a rand to work with, a strong rand to work with, and that putting your export revenue under pressure. That on the one hand, but it's also facilitating cheaper imports coming through, and that has been a long-standing risk for a company like Hulamin, where we've had Chinese imports really coming in and undercutting some of your market share. Just how much market share is being lost at this stage to cheaper imports?
Alishia, it's a kind of a tale of two cities in a way, in that Durban and Cape Town, being the coastal cities, are a lot more vulnerable to cheap imports than the central Gauteng region. Unfortunately, those markets, some of them up to 30%, have been lost to imports. And as a consequence of that, plus the fact that we have a lot of capacity in our extrusion business, we have now taken a decision to close that Cape Town plant and redeploy employees. So we will be servicing the Cape market from both our Pietermaritzburg and our Gauteng operations.
So that illustrative of just how much pressure the company is under as a result of this. We had an application being made to the National Trade Administration Commission for 10% duty on semi-fabricated rolled products. What kind of progress is being made on that on that front, where government is looking at tariff restructuring?
Yes, gazetted in the first half of this year was the outcome from the extruders, of which we are one, and that came in at 5%, which really isn't sufficient to compensate and to scare off these traders who are bringing in container loads of imports from a range of different sources. The rolled products application went in about 6 months behind the extruders one, and we are awaiting that outcome in the second half of this year. We again there applied for 10%, as you said.
Well, we'll be awaiting that, as well, and keeping a keen eye on developments there. In the meantime, let's take a look at that export market, because you're exporting, sales are on the up. But to what extent are margins still under pressure?
Alishia, the aluminium industry is showing some buoyancy, and we've certainly seen over the last 12 months or so a significant but gradual increase in selling prices or margins in our export markets. Certainly in the first quarter of this year, there was an undersupply situation, and so the orders that we've booked for the second half of this year generally have been at pretty firm margins.
Taking a look at the prices and the kind of improvement you're seeing on that front, in terms, if we put it down in percentage terms, just what kind of growth is coming through there?
Look, it's in the order of 5 to 8% margin, but that's in dollars, so it is helping us to some extent compensate for the very strong rand.
That, of course, together with, as you said, the ramp up we've seen in production as well, and that's happening in tandem. I mean, this time last year we were still waiting to see the effects of your assets from expansion projects kicking in. Are you happy with the volume side now and the return on investment that you're seeing there?
No, look, we still have some way to go. We completed a major expansion in 2009, and now we're on the ramp-up curve to the end of 2014, when our sales in rolled products will be at around 250,000 tons. So we certainly are on that treadmill, and we are pushing the business quite hard to get to that full capacity.
Of course, just looking at the manufacturing industry as a whole, I mean, we had manufacturing, the manufacturing sector used to be, what, 22% of GDP. It currently stands at 16%. What's your view on the kind of stimulation South Africa needs, or the kind of stimulus it needs to get back on track?
You know, Alishia, in a market particularly like ours in aluminium, where a lot of our customers in the local market need world-class products. World-class products comes with a certain critical mass of volume, and unfortunately the South African market is really small in global terms. So relative to all our competitors, we are much more exposed to exports than all of our raw products competitors around the world. What that means is that we are much more vulnerable to, for example, swings in the currency. In terms of protecting and helping companies like Hulamin, we need both assistance to attract investment, we need new customers in the local market, as well as some protection in terms of duties, just to try and compensate for that very wide exposure to exports.